Okay, you need to give me sharing rights also.
You should be able to share now. Yes, it's visible. Hi
Okay.
everyone. Welcome you all to this webinar. Today we are going to be discussing a very hot topic: financial independence, retirement early, FIRE. So today's speaker is Vivek Sharma, who is the head of investments at ST Advisors. He has over 2 decades of experience in trading and financial markets. Uh, and today he's going to be taking you through the true meaning of fire and how you can reach that. Welcome, Vivek.
Thank you, Ankit, and welcome everyone. Ankit, let's just, are we live on YouTube also?
Yes, we are live on YouTube as well.
Okay. Shall we wait for a minute or so? Maybe, I think few more participants might join.
Yeah, we have about 30 people and it's increasing by the minute. So we can perhaps wait for a couple more minutes before we begin. In the meanwhile, participants are requested to drop any questions that they have in the comment section, and we'll make sure to address them either in between the webinar or towards the end.
Okay, Ankit, let's begin. Yeah.
Sure.
Okay. So today's topic is fire, and there's a lot of interest. I see a lot of interest in the investor community regarding fire. Obviously, the idea sounds pretty exciting that you've saved enough that you don't need to work and you can retire on a beach in Goa or maybe in the hills in Himachal. But I think we all understand what does FIRE mean, which is financial independence, retire early. But just please share in comments one short sentence and word what comes to your mind when you think of FIRE. What's the idea of FIRE in your mind? So please share your idea of FIRE in just one short sentence or a word. I can't see anything right now. Have people started sharing anything? Yeah, it started. So
Yeah.
Natarajan says determinations and stubbornness. Chat is disabled. Ankit, can we?
I have enabled it to everyone. Let me check once again. Yes,
Okay,
now
now it's
it's
enabled.
enabled.
Yeah. So I'll maybe we can start reading it out. Natarajan says determinations and stubbornness. Ravi Sharma says freedom. Joel Fernandez says willing to do what's best. Freedom. Mithun. Nikonj fire to achieve. Buying time. Independence. Tarun says fire means I can hire my own time forever. Interesting. KB says freedom. Yeah, a few more. Maybe I can also type. For me, it's really optionality. It gives you a lot of options related to time, related to how you want to spend your time, how you want to spend your money. Let money do the job of earning. Interesting. Any more? Ankit, maybe you want to put what do you think about fire?
For me, also, it's all about options. It's about choices, having that freedom.
Yeah. Yeah. So we all have our own idea of fire. So let's, with that in mind, let's begin now. Yeah. So understanding fire, I think we all understand the definition of fire, but just maybe we can discuss that in brief once again. So the way we see fire is fire FI is the engine. So we have divided fire in two parts, frankly. Uh, the first one, I think all of us like that more, the idea of financial independence, which is if you have 30x of your annual expenses at this moment, you can actually, that's a pretty good number to really think about financial independence. You have almost reached that stage where you can think about retiring early also. But this specific number is kind of non-negotiable number, and it creates a lot of options in your life. Now, real estate, I'm talking about real estate, but it's retire early. Retire early is actually a destination, right? And this is totally optional. Stepping away from full-time work, stepping away from stressful work, maybe your job requires you to travel a lot, and this specific retire early is also not age bound. It's not that you have to retire at 60, you can retire at 50, 40, or maybe even earlier if you plan. But frankly speaking, in Indian context, I think retire early, you definitely, it sounds very exciting, but after a point of time in life, you need something to look forward to. If you're really retired, I think that's, at least in my mind, that's not a great idea. So financial independence is definitely a great idea, but retiring early, I have my own doubts, and we are obviously going to discuss the math about around it. And apart from the math, we definitely want to discuss some of the psychological factors also around it. So what we'll do now is I'll just maybe stop sharing, and we'll discuss a bit about what are the different kinds of fire, right? So people might have heard about different types of fire. It could be fat fire versus lean fire, coast fire versus barista fire. So let's just quickly discuss what these names suggest. What does it actually mean by these different kinds of fire? So first, let's talk about lean fire. Lean fire is really for the minimalists, and as the name suggests, you're barely there, right? So fire number here is actually just based on your bare essential necessities. Okay, you have really no room for luxury, no room for error in this case, very, very little room for error. And that's why here, this is the riskiest form of retirement, really, where you don't have too much flexibility around your expenses or around your investment corpus. And the market downturns can be really very, very, very stressful in this case, because you have just barely achieved what you need to retire, and also you just you saved enough for your bare necessities, so you don't have much flexibility really in terms of your spending habits also. So the example could be a person age 35. He's decided to retire in a say a tier 2 city where the expenses are really very low. He prominently they cook at home. They don't go out too often. You don't really own a car. You primarily are using public transport, and you take very, very local, low cost vacations. Your annual expenses may be somewhere around, let's say, 5 6 lakhs, and what you have saved is 30x of that. So 30x of 5 lakhs would be about, let's say, 1.5 crores is something what you have saved. So somewhere around that, 1.5 lakhs to 1.8, sorry, 1.5 crores to 1.8 crores is what you have saved. which covers for your annual expenses of about say 5 to 6 lakhs a year. So this is what lean fire is, right? It is somewhat popular also, but it's as we said, it's quite stressful also. So now, Ankit, shall we maybe take users through one of the case study here in Excel? We show them what does a lean fire exactly looks like.
Sure. Let me know when the screen comes up.
Yeah, I can see.
So, talking about the lean fire example, which Vivek just mentioned, suppose you're a 25-year-old person and you're just beginning to start work and you are frustrated already. You say, this is not for me and I want to retire by the time I'm 40. By the time I'm 40, I do not want to work. And of course, 15 years is not a very long time, and you understand that you have to make compromises somewhere. And as a result, you uh, tell yourself that I'm going to live a very ascetic life. I'm just going to live off 25,000 rupees, which is not a very big sum in a tier two or tier three cities. Perhaps you can live off 25,000 rupees a month. And if we take these assumptions, then your years to fire, like how many years is there till you reach your fire number, which is 40 years of age, is you have 15 years to work with. And your annual expense, inflation adjusted, would be 7 lakhs, somewhere around 7 lakhs annualized. And as a result, your target corpus would be somewhere around 2.4 crores. So you would want to have 2.4 crores.
That's
And
40 years
to,
down the line, right?
yeah,
Sorry, 15 years down the line.
that's 15 years down the line at the age of 40. So for reaching that number, today you would have to do an SIP of at least 59,000 rupees, assuming a 10% return. Of course, if you invest more aggressively, then these numbers can slightly come down and come up. But we have assumed a 10% return, and based on that, you would have to invest at least 59,000 rupees in the SIPs today if you think you can live off by just 25,000 rupees.
So, Ankit, in this specific case, if you see somebody is saving about 59, 60,000 per month, and their current expenses are 25,000, right?
Yes,
So roughly if somebody is earning 85,000 rupees post-tax, out of that you save about 60,000, you are spending 25,000. So yeah, you're saving maybe about 70% of your overall income. You're saving that. So you're living life very frugally at this moment. So that's what it means. Maybe save about 70% of what you earn, which is a pretty high number. It's a tough ask really to do that for 15 consecutive years, right?
yes, yes, definitely.
Oh, yeah, yeah. Okay, so let's move ahead to different types of fire, and obviously we'll come back here to this Excel, and we definitely want to discuss more about maybe your case where you are, if you want us to calculate different numbers for you, we'll be definitely happy to do so. So let's just move to the second popular fire method, which is a fat fire, right? Here you are not really downgrading your lifestyle. Uh, you have obviously very high income and very high spending, and and your income is so high that you are able to save for all the luxuries of life, which is maybe you drive a luxury car, you go on very frequent foreign vacations, and you have all the kind of luxuries, and you are not really downgrading your life to a tier 2, tier 3 city. You're living in a metro, having very high expenses and all of that, right? Um, so that is actually known as fat fire, but also it gives you a lot of flexibility, and you've saved so much that market downturns really don't affect your lifestyle choices. So if the market's correct by 10, 20, 30%, you still have enough that you don't get anxious about your high spending habits really. So that is fat fire. This is totally opposite to the lean fire that we discussed earlier. So, Ankit, maybe we can open the Excel and then quickly show what does a fat fire look like.
Sure. So suppose you're a 25-year-old person and you want to achieve that fire age by 45, let's say. And since you are achieving a fat fire, suppose you want to live off very lavishly and you want to have a monthly expense post retirement for 2 lakhs, suppose. So if you have, and let's say your current corpus is 10 lakhs. Then in this case, you would be required to do an SIP of at least 3.46 lakh rupees. So it's not for everybody. You need to be in that top income bracket to be able to achieve this fat fire number. Of course, you can always reduce your post-retirement expected expense if you want this SIP number to come down, or you could work extra years, or you could adopt a more aggressive approach and invest more heavily towards equity.
Okay, great. Again, I think very few are in this kind of a situation where they can really save for fat fire, right? You have to be really lucky to have that kind of a job that you are really aiming for fat fire. Great. Okay, thank you, Ankit. So let's just move ahead. Next comes coast fire. Again, this is quite popular, and I think, to be frank, the next two ones are the kind of fire that I personally like. One is coast fire and one is barista fire. So let's discuss about the coast fire. Now, coast fire, frankly, is a psychological milestone. It's not really a retirement date as such. The strategy here is you're saving aggressively from early on, and you hit your cost number. Again, we'll take you through the Excel and figure and help you figure out how to determine your cost number. But the idea here is you're saved enough for your retirement, uh, which is maybe 10, 15 years down the line. But you have saved enough that you don't need to contribute any more to your retirement kitty. So your retirement kitty uh, can keep on compounding, and you don't need to put anything. Only thing is, for your current expenses, you need to only cover that. So you can actually afford to take a less stressful job, which is not paying you as per your market salary. You are maybe earning 50% of your market salary, your market value, and but you can really survive on that and not really think about retirement because you've already saved everything for your retirement, right? The key limitation here would be it really requires a high early surplus, and it is again this kind of coast fire is easier for higher earners or those who with unusually low expenses early in life, right? So you have actually saved enough for your retirement. You don't need to save anything. So here we are just talking about retirement, and if you have any other life goals, obviously, like you have kids, you want to save for their education, their marriage, or maybe other goals. Now, all of those things are obviously separate. You need to save for them that separately. But here we are purely talking about your retirement as a goal, right? So, Ankit, let's take everyone through a coast fire example also.
Sure. So this is a typical coast fire example. So in coast fire, you have already built enough corpus that you do not need to add more to that corpus. So for example, if you're a 30-year-old person and wish to retire early by 45 years old, so you still have 15 years of work life, and you estimate that you want to live off by 1 lakh rupees per month, so 12 lakhs annually, but your corpus already is quite large. So you already have 2.43 crores in your corpus. Now you have already built such a large corpus that you do not need to add anything to it. So your required SIP per month becomes zero. So even if you leave your corpus to this 2.43 lakhs and let it compound for the next 15 years, So by the time you reach 45, you would still be able to retire off that final corpus and live off comfortably, which is 1 lakh rupees per month.
So Ankit, in these cases, what's the return on your corpus we have assumed here on this 2.43 crores?
We have assumed a fairly conservative since it's a retirement plan. You should have a balanced 50-50, 60-40
Yeah.
portfolio of equity debt. So right now we have assumed 10%, but of course, depending upon personal risk appetite and conditions, the expected estimates can go slightly up or down a notch.
Yeah, makes sense. Makes sense that if you are really have taken early retirement here, kind of early retirement, only you're working, but you're just working for your month-to-month expenses. You don't really need to save anything. It makes sense to have a more balanced portfolio. Yeah, because see, you'll start withdrawing from your retirement kitty 15 years down the line when you even stop working, even in this low stress job, let's say, so to say. So you'll start withdrawing 15 years from now. So you can afford to take slightly more risk in terms of your asset allocation. You can have higher equity, but again, it's a personal choice because in that case, you might really become anxious. 15 years is again a longer period. You are going to have 30-40% kind of correction definitely in the next 15 years. So it's maybe it's better to assume a conservative rate and also have a more slightly more conservative portfolio in this case. Makes sense. Okay. Okay. So let's move on to the next fire, uh, which is barista fire. Again, it's kind of similar to coast fire. In coast fire, you have already saved enough for your retirement. You don't need to save and let the compounding do its job. In case of barista fire, you really haven't saved fully. You're not 100% there yet, but you're maybe 80 to 90% there. So there's some investments you still need to do apart from your monthly expenses. You still need to add something to your retirement kitty, but it's not really a great amount. So you can still, in this case, maybe shift to a low stress work, which covers your monthly cost plus something. Plus something means you need to still add some bit of it to your retirement kitty, but it's not really much. And primarily, your investments still continue to do compounding in the background. You're not withdrawing anything from it yet, and you are maybe adding some small amount, nominal amount on a monthly basis, something like that. So, yeah, let's just, Ankit, take such an example also for Barista Fire.
Sure. So in Barista Fire, like Vivek mentioned, you have accumulated decent amount of corpus. In this case, you have accumulated 77 lakh rupees of corpus. But this 77 lakh is not enough to just let it be. It's not enough to let it compound on its own and not add any more SIP. So if you see these numbers, suppose I want to live off by 30,000 per month, which is not extremely large, but it's somewhere in the middle, and I want to retire by 40 years, then the SIP that I would need to do per month would be at least 5,000. So if I had the name, why the name barista is there, it's because suppose I had a very arduous job, high paying job, and I used to work extremely long hours. But because now my required monthly SIP is just 5,000, I can perhaps quit that long hours job and pick
Hmm.
a job as a barista at Starbucks or a very any other job which is not very demanding, and put this 5,000 from that salary and enjoy the rest of my time doing what I like.
Yeah, yeah. And the interesting part here is you're almost there, not 100% there, but you're almost there. So maybe you're taking a early plunge. I think this is an interesting choice really. So it gives you some bit of idea about what retirement or coast fire would be. So you can maybe take that plunge slightly earlier But in this case, you definitely need to work and you definitely need to add something to your retirement kitty as well. So in this specific case that you have shown, you still need to add at least say about 5,000 or so to your retirement corpus every month.
Yes.
Okay, great. Okay, let's move on to the next kind of fire, which is again, I think quite a lot of people like this, especially in India, because people, it's now that people have started investing a lot in equity markets. But I think for our parents' generation, and even for a lot of people in our generation, building hard assets like property, real estate is something that people really love here in India. So this is cash flow FI. In this specific case, the strategy is you build hard assets that generate regular cash flows. So you purchased a house where you're getting rental yield, or you have a small office or a shop which you have given on lease, and you are earning maybe about somewhere around 3 to 6% yield on that specific shop or property. In this specific case, what is happening is the income from this rental income is replacing your salary. Your principal again remains largely intact. You are not really, in fact, you don't have that option of taking out money from your principal because it's tied in a very large and illiquid properties. So this is another example of the kind of fire that people really like, where they've built hard assets. So you don't really need to aim for 10, 15, 20 crore kind of unrealistic maybe corpus. If you have say about somewhere about 3 to 5 crore in these hard assets, you can expect to earn say between, so if you have let's say 4 crore worth of property, from that if you are able to achieve a rental yield of say 5%, which is possible in commercial property. So 5% of 4 crore would be about 20 lakhs or so. And it's interesting here because property, I think, really appreciates along with inflation. So your income is also protected. You are getting that in inflation adjusted income. As with the inflation, the property prices keeps going up and you'll keep on getting. Obviously, the risk is that you're unable to lease out your property from time to time, and that hampers your cash flow. So that's the risk in this specific kind of strategy where you have rental property, as against investing in stocks, which has a different kind of risk, in the sense that if markets correct by 10-20%, obviously that your corpus takes a substantial hit, really, right? So these are the five kind of fire that we have discussed, and maybe I can quickly take you through. Maybe we can summarize and take you through all these five kinds of fire. I'll quickly share my screen. Yeah, Ankit, can you see my screen?
Yes, Vivek, it's visible.
Okay, so these are the five kinds of fire: lean fire, fat fire, barista and coast fire, and then cash flow fire. Uh, we are segregated between the lifestyle cost, the work status, and the key goal here. So in case of lean fire, your lifestyle cost is very low, as against fat fire where it's very high. Barista fire, it's kind of medium, and coast fire, it could be variable, and even for cash flow it's variable. Your work status, you are actually retired in case of lean and fat fire. In case of barista and coast fire, you are doing a job, uh, and in case of Parista Fire, you are actually putting in some money in your retirement corpus also. And cash flow, it gives you a lot of time. You can be self-employed because you have that passive income through rental yield, right? And the key goal in all of this is lean fire. It's the maximum free time. In case of fat fire, the goal is to maximize the lifestyle comfort with all the luxuries in place. For barista, it's better work-life balance. For coast fire, it's the psychological freedom from saving. And for cash flow fire, it is income replacement. Okay, I think we started getting some questions. We'll definitely take it towards the end, but please do share if you want us, and obviously we'll share this Excel that we have shared with you, all of you, after this. But please definitely share if you want us to maybe take your specific case, so you can maybe share your statistics here, and we'll be happy to take you through one of these fire methods that you want us to take us through. Okay, let's just move ahead now. Okay, so I think this is the maths that we have discussed, but then there are a lot of other psychological factors that you need to think before you actually start considering fire, right? So these are the key self checks, and what I want you is definitely take a minute, think about these questions, and maybe if you can please share uh, your responses to these specific questions. So, who are you without the job? How will you fill your time when you actually intend to retire? What do you propose to do? Obviously, you should have something meaningful to look forward to. So, what is your idea about retirement and how do you fill your time? Is it that you're running away from your stressful job or you're running towards something? Right? Would you still do this work if money didn't matter? I think that's a very important and interesting question. That if you have that fire, if you have achieved your fire number, would you still be doing this current job? And if your answer to this is yes, then definitely you are one of the very few lucky people who have found work where you would want to do it, even though you have all the money in the world, which means you have achieved financial independence. And again, for a lot of us, really, our identity is tied to the work we are doing. So, can you really introduce yourself without your job title, right? Would you be okay? And a lot of us really, it's a very hard decision. And to many people that I have spoken to who have gone down the path of fire, I think this is one of the big question that they realize only after going down that path, that they have this identity crisis, that they find themselves maybe worthless, that if they are not doing any job, you really don't have any identity in your eyes and in eyes of society, your family and others, really. So please maybe take a minute and please let us know your thoughts around these four questions.
What's your answer, Vivek, to these questions?
I'll definitely share my answers, but I definitely want people also to share something around these answers. But I'll definitely happy to share my answers also. So yeah, let's start sharing. I haven't seen any comments yet, but yeah, I think okay, that's a question really. Okay, I think let me start then. If people are not sharing, let me only start. How will you how will you fill your time? I think for me, I love investments, I love markets. So definitely I'll be doing something related to markets, related to investments. And that's what pretty much maybe 70 to 80% of my current role is pretty much that. So if you ask me the third question, would you still do this work if money didn't matter? Probably yes. Either this job or something very, very similar. But I really love market, so it's going to be something in the investments domain only. Are you running away or running towards something? I think it will give me. I'm almost there in terms of achieving my FI number, so it's not running away from anything. It's just that I've for the last 7 8 years since I started in this job, I've been thinking very actively about savings and investments, and which has helped me uh, reach my FI number. Can you introduce yourself without your job title? Really, as I told you initially, that I don't really intend to retire. So I definitely like the concept of financial independence, but I don't really like the concept of retiring early. So, to the extent it is possible, I would definitely would want to keep on working, and I don't think I can really be without a job. or without working. So that's not really, at least for me, that's not really the case. Yeah. So that's for me. But Ankit, would you want to discuss your answers to this?
I will have pretty much same answers as you, Vivek. I too cannot sit idle, so I need to engage myself into something, some sort of a job, and I need to fill my time. So retiring early is something which is not personally for me, but I can resonate with a lot of people who might would want to retire early. So for me, job is pretty much my identity. So if you take away the job, then there is a big vacuum. So for me, it's an essential part of my life.
Yeah, great. So we have started receiving some responses, but I agree. I think with the responses also, Mithun has said saying that there are a lot of areas on the personal front that gets neglected, which I would be free to pursue. And this is interesting. I think just yesterday I was talking to someone who is, I think, currently around 50 or so, who has taken early retirement. And this is exactly the point that he mentioned, that now because he has so much of time, he's actually retired. He's not doing anything. But this exactly point that Mithun has mentioned, he also said this point that while you are doing your job, in a full-time job, you really don't get time to uh, spend with your family, with your kids, and even talk to your friends, talk to your relatives. And now that he has so much of time that he is able to talk to them without any constraint of time. So that is something that he also mentioned. Traveling, spirituality, interesting. Yeah, traveling is something that I personally love. That is, I think the only thing that I don't like here is more flexibility, although we are working from home mostly, but maybe more flexibility so that I get more time to travel is something I would love. Yeah. Not running away, but running towards something, Mithun is saying. And the third answer is no, definitely engage myself with something meaningful that aligns with my skill strength. And the fourth answer, can you introduce yourself without your job title? We are saying yes. Interesting. Okay. Thank you, Mithun. Thank you, Aryan, for sharing your responses. Okay, great. Let's just move ahead now. Again, there are other sort of questions also, because it's not really a personal choice. It's more of a what your family wants to do. So, is your family truly on board with this decision or not? Can you really handle a long stretch of restraint? And which is the fire method that is really meant for you? Should you just plunge in, or should you glide into fire? So, these are some of the questions that one really need to think through a lot and answer before really taking in that plunge of retiring. Definitely, maybe not so much for financial independence, but definitely for retirement, early retirement. You need to think through all of these questions, and it can take maybe definitely months, but at some time it can take few years also to really think through these questions and arrive at what is it that you really want to do. Yeah. So now let's deep uh, let's dive deeper into the math around this financial independence number. So one concept we want to introduce here is the safe withdrawal rate, right? And you'll hear a lot about this in the next few minutes. So what safe withdrawal rate is? It is the maximum rate, that maximum percentage. It's defined in terms of percentage, that the maximum rate you can actually withdraw from your retirement portfolio without risking its premature depletion over a 30-year period. So why SWR is actually 30-year period, why we have mentioned 30-year period, is because initially when all of these research was done, it was assumed that somebody is retiring at a regular retirement age of 60, and the lifespan is of 90 years. So you spend those 30 years in retirement period. So that's why most of the research around safe withdrawal rate was done using a 30-year retirement period. So for example, let's say somebody is having 5 crore in his retirement corpus currently. So what is the maximum percentage, whether it's 3%, 4%, 5%, how much you can actually withdraw from that 5 crore portfolio safely so that it lasts, it has a very good probability of lasting for the next 30 years, right? So let's take this example of say 5 crore again. If your safe withdrawal rate is say 4%, in that case, you're able to withdraw 20 lakhs, which is 4% of 5 crore in your year one. And next year, you are not withdrawing that 4%, you are adjusting what you have withdrawn in first year for inflation. So let's say if the inflation is 6%, then you increase your what you withdraw in the first year by 6%. So 6% of 20 is 1.2. You increase your withdrawals by 1.2 lakhs. So your total withdrawal in the second year will become 21.2 2 lakhs, and so on and so forth. So it really does not mean that you are withdrawing 4% every year. It means you start with 4% and then you adjust that 4%, that money, for inflation, and then you keep withdrawing. So this is what the safe withdrawal rate is, right? Now, where this safe withdrawal rate comes from, and where you might have heard about that 4% rule. So if you need to retire, you need 25 times of your annual expenses. 25 times is coming from 4%. So if you divide 1 divided by 4%, you get that 25x number. Where this is coming from? This is coming from a very popular research done by Mr. Benjamin, who was a financial advisor, retirement planner. It is based on US data from 1926 to this specific study, I think, was done in 1992. So for that kind of data, it was assumed that this is meant for 30, this specific retirement corpus should last 30 years. And broadly, the asset allocation was about 50 to 75% in equity and the rest in bonds. Right. And this is, as I said, very widely cited on social media, on financial blogs, that this is the number one should aspire for. And we'll see what number really makes sense in case of fire. 30 years longevity. But the main question here is, does this number matter for Indian context? Because this whole research was done in US. In case of India, the returns are much more volatile from stock, and the inflation and bond returns are also quite different from what they were in US. So it's a totally different context. Uh, Again, as I said, ki for the 4% rule to work in India really does not make sense because of these returns. India has very higher structural inflation, and it's totally different economic soil. You simply cannot copy paste those rules into India. So what works in case of India? In case of India, based on the research that this is a very popular research done by Ravi Saraugi, where instead of 4%, what he is proposing is the range is somewhere between 2.6% to 3.5%. And this range is dependent on how conservative or how aggressive you want to be. If you're really aggressive about your retirement planning, uh, then maybe you can afford to retire at 30x of your corpus, and the withdrawal rate would be about 3.5%, but a balanced number would be somewhere around 35x instead of the popular 25x number that you use. So in case, let's say, for example, if your yearly expenses are 10 lakhs per year, in that case, what you need is 10 lakhs into 35, which is 3.5 crores is what you will need. And you can start withdrawing 3.3% from that 3.5 lakhs, right? So this is what the Indian data tells us. Roughly between 30x to 40x is what you should be saving, right? Now let's look at the probability of success, because all of this is probabilistic. The returns from markets are also not fixed. So, in case of 30 years, your success rate is about 82%. So, 82% of the time, uh, your retirement corpus is going to last 30 years, whereas rest 18% of the time, you're going to really withdraw all of your retirement corpus, and you really don't want to be in that space. So the probability of success here is 82%. And this is for 30 years. Now, if you're retiring early, so if you're retiring at, let's say, 50 years of age, in that case, your period of in retirement is 40 years. The below x-axis is the period of retirement. So if you are retiring at 50, your period of retirement is 40 years. In that case, if you have that same 25x saved, or if you're withdrawing that 4%, yeah, then your probability of this lasting the whole next 40 years is just about 53%. And if you actually are retiring at 40 years, so your retirement period becomes 50, then your probability of success is 36%. So this is definitely not where you want to be, right? So what do you do? How do you improve this probability of success? Now, this is all, these numbers are based on fixed withdrawal, right? What can you do to improve your chances of success? This is what you can do. And again, this is based on a very popular research by Vanguard. So these numbers are genuine and research based. These are very scientific numbers. So as we said, that your your sorry, yeah, yeah. So if you take only 50 years of retirement period, your probability of success is 80 is very low, and what you can withdraw is just 2.6% of safe withdrawal rate is what you can assume. How do you increase the safe withdrawal rate? The way to increase the safe withdrawal rate is if you diversify your portfolio. So instead of just sticking to domestic investments, if you also uh, if you also have international uh, equities in your portfolio, in that case, your safe withdrawal rate increases from 2.6 to 2.8. Again, if you keep your fees low at just about 20 bips, which is only investing in index funds, then this increases to 3.3%. And if you are able to do both of this and do dynamic spending. Now, I'll cover in the next slide what do you mean by dynamic spending. But if you are okay with not withdrawing fixed amounts every year, and if you can be flexible about your withdrawals, then you can actually achieve that 4% of withdrawal rate, right? So these are the three things that you can do in order to increase your probability of success. Now, what does it mean by a dynamic withdrawal rate? So till now, what we discussed is the fixed withdrawal. In this case, what happens is it's quite simple. There are multiple ways, there are multiple methods. There may be about 30 to 40 methods. But in very simple terms, it is that if your overall corpus is increasing, if the markets are good and your overall corpus is increasing, you can maybe withdraw slightly more, uh, but if the investments are struggling, if the markets have seen correction and your portfolio hasn't really gone up, in that case, you should withdraw something less. So it could be maybe you are just not taking into account inflation. You're not increasing your withdrawals by 6%. You're just withdrawing what you withdrew last year, something like that. So if the markets are doing well, you withdraw a bit more. If the markets are struggling, you withdraw a bit less. So that kind of flexibility really increases your probability of success, which means you require lesser investment corpus to retire early. So these are the three things one can do: dynamic withdrawal, diversify your investments, and the third thing is keep your fees low. Okay. Okay. So Ankit, let's just stop here. I think we have covered whatever we wanted to cover, and maybe we can take questions now. Questions, comments.
Sure, Vivek. So Pawan is asking, do we need to invest in international mutual fund also? Is it going to help us in our fire journey?
Yeah, I think what the research shows and what we have presented in the last few slides, and that's what the data also tells us, that if you invest in Indian equities and have some allocation to international equities. In that case, it really helps, maybe not so much in terms of returns, but definitely in terms of stability or the volatility in your portfolio reducing, and that really helps you a lot. So yeah, it definitely helps if we have a decent allocation to international equities. That will definitely help. Yeah.
And how would you advise people to get that exposure?
Okay, so I think it's a slightly longer answer here. So there are three ways you can take international exposure primarily. I think the first one is obviously through these mutual funds which are listed in India. But most of these mutual funds, obviously, there's a limit because these mutual funds have, I think, $7 billion is the uh, limit from RBI, that these mutual funds combined can only invest $7 billion. This limit, I think, came into effect maybe about more than 15 years back, and the industry is really expecting it to get revised, but it is not getting revised anytime now. It doesn't look like this limit will be revised. So that's a limited option, but that, if there is an option from time to time, maybe whatever redemptions they receive, they can only take in so much of money, but they cannot take in any new money. So that limit is basically, and frankly, that option is really not on the table. But that was a straightforward option if that option was available to investors. The second option is through LRS, right? So through LRS route, one can invest, I think the limit there is 2.5 lakh dollars per year. One can invest internationally. The problem there is again that there's a problem of TDS. So if you are investing more than 10 lakhs, then you got to pay advance tax on it. It's not really a tax because you can that this tax that you pay, advance tax, will be set off against the actual tax, so it will be reimbursed, but again it's problematic there. uh, and the second issue is also that uh, of US laws, really. So what US laws say is that if you are investing, if you opened an account directly with a broker in US, uh, and if something were to happen to you, then US can essentially take away uh, 40% of what you have invested, not profits, but of what you have invested, they can take away. That's the estate tax in US, right? So that's slightly risky option. And obviously you've got to manage your money on your own. Third option, which the third option that I like is through the gift city. And through Gift City, these funds are opening, which is not through, which is over and above that $7 billion limit for the mutual fund industry. So that route is open, and now many mutual fund houses have now started these funds, which is the fund of fund structure. They take in money from here and they invest in US funds. The good thing about that is the US estate tax that we just spoke about, it is not applicable to the FOF structure. So it's safe there, and it's a very nice way of investing in US equities or international equities. So though out of those three options, the Gift City is, I think, the best option in my mind.
Thanks, Vivek. Pawan is asking, how do you choose a good financial advisor, and do you need it if you are already investing in regular funds via an advisor?
See, if you are already investing in regular funds via an advisor, see, the numbers in my mind, I think, are pretty clear that a good advisor, I think, can add anywhere between 2-3% to your uh, uh, overall returns. And this is over long run. It can easily add, but only a good advisor. And that 80-20 rule here also, I think, stays that maybe 80% of the advisors are not really good. It's just that 20% of the advisors are really good, which can help you achieve that 2-3% extra over time. using the fund selection, but primarily managing the behavior. How do you invest? When do you take out money? Because a lot of mistakes investors make during not during normal times, but during markets when they are in bubble and when they are really depressed. So I think good advisors can add that. How do you select really is something I haven't really thought through, but if you ask me right now, I think you just have to talk to investors and identify uh, his motivation. So if he's primarily talking about products, if he's primarily talking about returns, I think he's not a good advisor. If he's talking about your goals, about asset allocation, those are the areas where a good financial advisor can add value. But if he's almost always talking about products, you can be pretty sure that he's trying to sell you products because of the commissions he's earning. But then there are few good advisors who keep the client first and really not sell you products, uh, but uh, uh, but help you in attaining your financial goals.
Yes, I think some people are getting confused with that safe withdrawal rate. People are
Yeah.
confusing it with, I think, annual withdrawal rate. So if you could throw light on that and explain how 2.6% safe withdrawal rate equates to 40x, but if we increase the safe withdrawal rate to 3%, then it falls down
Okay.
to 35x.
Yeah. Yeah. Let me just maybe open an Excel and show. I'll share my Excel and we can run through these numbers once. Okay. Let me know if you can see my screen. Yeah,
Yeah,
Ankit, can you
it's
see my screen?
yes.
Okay. Let's take the safe withdrawal rate and let's start with 4%. So So safe withdrawal rate of 4% would be if you divide 1 by this 4%, you get 25. So what the multiple you need is a 25x multiple. If let's say the safe withdrawal rate is 5%, if you can withdraw 5%, then what happens is you can actually, what you need is 20 times of your expenses. So again, let's say the annual expenses are 10 lakhs. Yeah. So the corpus you need is 10 lakhs into this multiplier, which is 2.5 crores. Yeah. Uh, okay. Okay. In this case, also, if this is 10 lakhs, your retirement corpus is 10 lakhs into 20x, which is 2 crores. If let's say your safe withdrawal rate is pretty low, it is 2.5%, which means what you need is 40 times of your annual expenses, right? So for the same 10 lakhs worth of annual expenses, your retirement requirement is about 4 crores. So this is how a safe withdrawal rate translates into these multiples, which translates into the corpus required. Yeah. And maybe Ankit, what we can do is we can again open the Excel that you were earlier showing, and we can maybe have a look at few more cases and look at the multiples that are required in different cases. Yeah.
Yes, and in this example, Vivek, so in the first year, I am going to how much expense
Yeah.
I'm going to be able to withdraw. It's going to be 20, this
Yeah.
2.5 crores
So
times
let's take,
4%, right?
yeah, yeah. So in the first year, what you can withdraw is 4% of this whole corpus, which is 10 lakhs, right? Again, in the second case, again, that's the back calculation. You are withdrawing 5% of this. So what you're withdrawing, because your annual expenses are so much, you need to withdraw those annual expenses from your retirement kitty. Only thing is your retirement kitty is is dependent on these multiples key, whether it's 25x or 40, it's dependent on how aggressive or how conservative you are, or dependent on the time frame also key, whether it's for 30-year retirement period versus 50-year retirement period. Those are the factors that that really impact these multiples. So in the first year you are withdrawing obviously the same. Now in the second year you add inflation. So let's assume that in first year the inflation was, let's say, 7.5%. So what you're doing is you take this and you add 7.5% to your previous year's number, which will come out to be 10 lakh 75,000. So this is what you will keep doing.
Understood. So the sacrosanct factor here is the annual expense of 10 lakhs. You want to achieve this. And
Exactly.
SWR and multiple are basically the factors, the combination factors that are helping us achieve that. So if we have a smaller SWR, then we are going to need a higher multiple
High number.
to
Exactly.
compensate that.
To compensate.
Understood.
Yeah.
I hope that
Okay.
answers the question. Let's see if we have any more question. So Nikunj is asking, what about taxation on income from withdrawal?
Yeah, taxation you need to take into account. You can maybe assume that taxation, uh, because again, you are, let's say you're already retired, there is no other income. So you can afford to withdraw from debt. So let's say if you are invested in, say, FD, that interest normally it's taxable because it's over and above your income. But if you have zero income, then that is really not taxable for you, right? So as per the tax law, so you have to really optimize, work with your advisor maybe and optimize. If you already have an income and you are in a state that you have some income and maybe you want to withdraw something from your retirement corpus as well, in that case, what will be the most effective way is, I think, through equities, because through equities, if you are withdrawing, you are charged that 12.5% of capital gains tax. So that might be the most efficient along with income. But if you don't have any income, then you invest in those instruments where it is not capital gains tax, but first it is your uh, income that is taxed. So that's where you need to optimize a bit dependent on whether you are earning or how much you're earning.
Understood. I can't see any more questions, Vivek. I think we
So
can close
there
the call.
are some in the chat also.
Um, I'm not able to see any more questions. If
Okay,
you can see
there are,
them, feel free to pick it up.
okay. So what is one is what's the average rate of return to target over 5-year period? Yeah. I think I'm not clear about whether it's during retirement or prior to retirement, but to be conservative, really, if you assume that, say, equities give over long run average 12%, again, that's the average. Some years it will be zero, some years it will be very high. So equities give maybe 12% on average, and fixed income is able to give you, say, about 8%, or maybe now it's slightly reducing. So if you have a 50% allocation to equity and 50% allocation to debt, you can achieve somewhere around, say, 10-ish% is what you can assume. And frankly, for any other goal like buying a car, going for a vacation, you can target higher returns, maybe take more risk. But here you would want to be more conservative in your calculations, and the more conservative you are, the better it will be for you. So maybe about 10-ish% is still, I won't say it's too conservative, it's kind of average expectation. It's not too low, it's not too high, right? Uh, okay. There are few questions. How does Okay, Kaushik has asked, how does loans like home loans play important role in fire? Is it fine to take home loan or just wait for retirement corpus to buy a home? See, it's a very personal choice. Frankly, if I'm aiming for retirement, I would, or financial independence really, I would not like to have any kind of loan. That gives me the peace of mind, the comfort really. So for me specifically, and I think for large number of people, what I would suggest is definitely uh, any kind of loan during your uh, retirement phase is not recommended. Definitely, if you are still working, if you are aiming for retirement at that point of time, if you have taken a loan and home loan, all other kinds of loan, I can't think of any other loan that one should take. But home loan is definitely, I think one can take a home loan, but definitely not through in retirement. So my suggestion would be that you should not have any kind of loan when you have stopped working. Yeah. We'll definitely be sharing this sheet with everyone. Ankit, how are we sharing? We can obviously mail everyone who has registered, but any other way that we are sharing?
I've already added the link to the sheet and the chat so people can already download the sheet from there, but we would be sharing the sheet
Okay,
in
great.
the email as well.
So it's in the webinar chat that you already added the link. You can download it now, and for the others, we'll definitely be emailing it also. Okay, Ankit, here's the question for you. Maybe you can open an Excel and show us. So the current investment is 50 lakhs. Investment amount per month is 1 lakh. Target time to retire is 10 years. What should be the ideal amount to retire? But here, what Divakar you haven't given is what we'll need is the expenses also. So you can, Ankit, maybe assume time to retire is 10 years. So maybe you can take his age as 35 and fire age as 45. Or if you can maybe Divakar send your more details, your current monthly expenses, maybe assume whatever you want to assume, 75,000 per month, 1 lakh per month. Okay. Current corpus is 50 lakhs. And in this case, what you are, Ankit, assuming is a balanced safe withdrawal rate of 3%. Okay. So, yeah, Ankit, what does this tell us?
So this gives us, if you're really looking for 75,000 rupees monthly expense post retirement, then you would need to do 2.1 lakh rupees SIP per month as of right now. So which is pretty high.
Which is pretty high. Yeah. So 10 years, I think what can be done here is maybe 10 years is a bit early. Yeah, you need to plan much more in advance. As we saw in case of lean fire, even a very low corpus requirement still takes about 15 years or so. So what if we increase this 10 years to 15 years? In that case, how does the numbers change? So,
It comes down
okay.
drastically from 210 to 135 now.
Yeah, yeah. So I think you need to plan much more in advance. Really, 10 years might sound like a decade, a long time, but for retirement planning to save that kind of money, uh, 10 years is really not good enough. Maybe 15 to 20 years is something. What if you change it to 20 years? So he's currently 30, he wants to retire. Okay, 25, and yeah. Maybe see 50 lakhs for a 25-year-old to save is a tough ask. Let's say we change the current age to 30 and retirement fire age to 50. And you have already saved 50 lakhs at 30. Uh, so what one needs to save in this case would be about 89,000 or so. Okay. And Ankit, how does this change based on a different safe withdrawal rate? So currently you have assumed a 3%. What if you change this number to aggressive 3.5%? In that case, how does your requirement change? Okay, so your 89,000 SIP actually changes to 70,000. That's a fair bit of reduction. If you are slightly aggressive in terms of how you want to plan for your retirement. Okay,
Aggressive means that your probability of portfolio depleting before uh,
is
50
is
years
higher.
would be higher.
Is higher. Yeah, that's the risk you are taking. Maybe slightly higher risk you are taking. Okay. Okay, Tarun is asking, is this 4% based on US market? Yes, Tarun, that 4% rule is based on US market. It's based on 30-year retirement. And so that 4% actually reduces if you see Indian markets, and maybe it reduces slightly further if you are planning to retire early. Right. So those are the two factors broadly that would impact, that would reduce this 4% rule. But then the other factors also increase. So as we mentioned, ki if you are up for more diversified portfolio, if you are okay in only investing in index funds and keeping your fees low. And the third point was that if you are okay with slightly flexible, uh, if you are flexible in terms of your spending habits, then those three factors help you increase your safe withdrawal rate. So to against 4%. So that 4% might be valid for India, but in case you are doing those three things. Yeah. Okay. Sachin is asking 2.6% safe withdrawal rate says 40x annual expense. Yeah. Say 36 lakh annual expense will need 14.4 crore. But 3% safe withdrawal rate says 35x. So 36 lakh will need 12.6 crores. How does increasing withdrawal needs a lower corpus? Kindly elaborate. So Ankit, can we open Excel and look at these numbers?
I think Vivek, we covered this question. So
Okay, okay.
we mentioned that the expense is
Yeah,
sacrosanct. So if you are
yeah,
having
yeah.
a lower withdrawal rate, then you're going to have a higher multiple. So
Right.
that
In
2
in the
point,
Excel that I shared,
yes.
we covered this
So,
point.
so that 2.6% times the 40x your annual expense would be equal to that uh,
Yeah.
expenditure when you're retiring.
Yeah. There are a few more questions here. KB is asking, we talked about 40 times annual expenses at the time of retirement. Is my understanding correct? So, KB, I think you should look at the Excel that Ankit was sharing. You can download it. Just play around with those numbers because it depends slightly on how aggressive or how conservative you want to be in terms of your planning for retirement. But it's a slightly broader range of maybe 20x where have you are still working, but in a maybe in a low paying job, but which doesn't give you so much of stress, and at the other extreme it is 40x. So the broad range is maybe 20x to 40x dependent on which kind of job you're working, how aggressive you are with your expenses, with your investments, and all of those things. So that's a very big range, but what number is valid for you, you should definitely spend more time with that Excel. See what kind of fire suits you, whether it's coast fire, um, barista fire, lean fire, fat fire, all of those kind of things, and also your how conservative or aggressive you are. So just play around with those numbers, and you will get maybe more clarity. It's not exact. It might be 40 for you. It might be 20, 25 for someone else. Really. Yeah. Yeah. I think we have covered almost all the questions now.
Yeah.
Great. Okay. Thank you. Thank you, Ankit. Thank you,
Okay.
everyone, for attending this. I hope this was useful for you. Do download that Excel and play around with it.
Thank you, Vivek.
Thank